We all love to watch the stuff on HGTV where people go and shop for a house. That's the fun part. That's the stuff that you can make a television show out of. Applying for a mortgage loan is not as exciting. Sorry to my mortgage lender friends, but it's a necessity in the process for most people. If you have cash to purchase a house with, then most of this segment's not going to be too important for you. If you have enough cash to buy a house, all you have to do is prove it. You can print out your bank statement, your stock accounts, wherever you have the money. You just have to generate a printout of that with the date and your name on it and your balance to prove that you have the cash to buy. At that point, you can make offers. That's all there is to it if you're buying with cash. For the rest of us, we get a mortgage loan to buy our house. There's a lot of types of mortgage loans, and we will talk about them here in a moment. First things first, why is this segment before all the others? Don't we need to find a house for you to buy before it matters about the mortgage? Yes, but think forward. If you find a house to buy, your next step is to make an offer. Your offer won't go anywhere unless the seller can see that you are qualified to buy the house, meaning you have the cash or you're approved for a mortgage to buy. So that's why we start with the mortgage. You have to make sure that you will get the funding in order for us to be able to make a competitive offer for you that a seller will accept. And in fact, most sellers won't allow people to come and see the home unless they've already been mortgage pre-qualified. Types of loans. The most common types of loans are the conventional, VA, and FHA. Let's start with FHA. That's a first-time home buyer product. Generally, you put 3.5% of the purchase price as your down payment, so it's a relatively low down payment. You can have a higher debt-to-income ratio. You can borrow funds from a family member, and your credit may not need to be quite as high as for a conventional loan. FHA loans may or may not have a higher interest rate than a conventional loan. Just talk with your mortgage lender about what those rates are looking like. What's great about the FHA loan is the lower down payment amount, and sometimes you can qualify for an FHA loan when you may not qualify yet for a conventional loan. You can only get an FHA loan if you don't already own property. That's why they call it a first-time home buyer loan. In reality, if you've bought a property in the past, but you no longer own it, you may still be able to get an FHA loan. You actually don't have to be literally buying a property for the first time. However, you can't own property right now, and you can't have owned property in the last couple of years if you'd like to get an FHA loan. The conventional loan is the default loan, I guess you'd say. Rates vary depending on what lender you work with. The fees and costs associated with getting that loan can vary. You can shop around and talk to a few different lenders about what your interest rate would be. As far as down payment, 20% down payment is the gold standard, but it's not always necessary. This is where we get in the weeds just a little bit. If you are considering a conventional loan and you're not able to make a 20% down payment, then your loan will have what's called PMI on it. That's a private mortgage insurance. It adds a little bit of cost to your monthly payment. It protects the lender in case you default on the loan. Defaulting on the loan means essentially your property is going into foreclosure and the lender takes the house back. They need that coverage for themselves if you are not putting a 20% down payment. When we talk about down payment, we're measuring that off the cost of the home. So you are buying a $200,000 house, a 20% down payment is $40,000. If you've saved up that much money, it might make a lot of sense to use that for your down payment. But a lot of people choose to take on that PMI on their monthly payments in order to not have to make such a big upfront down payment. Many cases, people put 10 or 15% down, but there are many lenders who will do a loan for you at 5% down or even 3% down. And in Colorado, we have a program called CHAFA through the state of Colorado that can help you buy a house with as little as $1,000 down, actually. Some of the fees for that loan can be a little higher and your interest rate may be a little higher. But if it's the right time in your life to buy a house and you qualify for a CHAFA loan, you could look into that. The VA is an excellent mortgage product, and you guessed it, it is for members of the military and past members of the military who qualify for a VA loan. The wonderful and well-renowned aspect of the VA loan is there's no down payment requirement. If you would like to make a down payment to keep your monthly payments lower, that's at your option. You certainly can choose to make a down payment on a VA loan, but you don't have to. There is a VA funding fee that does make the total amount of money borrowed a little bit higher than it would be on other loans, and you pay it off over time. The other big benefit of the VA loan is you don't have PMI, so you don't have that extra cost on your monthly payment like you do with a conventional loan if you make a low down payment. So that's a really excellent benefit for members of our military. Here in Colorado, nearly every lender funds VA loans. You don't need one specific lender to get a VA loan. So if you've served in the military, make sure to check that out because many times that is the best option for you. If you submit a loan application to a few lenders, then you can compare your monthly payments, costs and fees, and interest rates among them and select which lender you'd like to work with. Remember, those numbers on the paper are not the only determining factor who you'd like to work with. I like to have my loans serviced locally. I feel more comfortable that way, and I know that I can just walk into the bank and have a conversation if there ever comes a rough time in my life where I may need to delay payments or work out a different payment schedule. For me, that's a nice comfort. There's lots of big banks all across the United States that fund loans. The institution may be based in a different state. You can cross-check those. You can also cross-check with mortgage brokers. The mortgage brokers will tell you that they save you money because they have access to all the loans you qualify for, wherever those may be originated, and they'll find you the one that's the best deal for you. So you can cross-check national brands, local brands, and mortgage brokers to see what works the best for you. It's not a one-size-fits-all. Everybody has different needs. Everyone's finances are different. The only way to find out is to talk to a couple of different lenders, submit your applications, and then have those conversations about the figures, about your monthly payments, interest rate, and fees. So like I said, those numbers are not the only determining factor. We also need to know how long does it take that lender to close. Some lenders can close a loan in a couple of weeks. Other lenders take more than a month. We need to know the duration of time we'll have to wait for funding. You can make a stronger offer to a seller and have a better chance of a better deal on a house if your loan can close in a reasonable amount of time. So that's a very important question to ask. And we also want to be very clear about how much your closing costs are on the day of closing. Everyone remembers that to buy a house, you need a down payment. Most people forget that you also have to pay your closing costs for your loan if you're buying with a mortgage. Again, if you're buying with cash, this stuff doesn't apply. Your closing fees are very, very small if you're buying with cash, very little. If you're buying with a mortgage, though, you have to pay the fees to get the mortgage. In some cases, we can negotiate for the seller to cover those fees at closing. It is a better plan, though, for you to prepare to pay them for yourself so that you can make the strongest offer on a home that you want. So we'll discuss that based on what part of town, what price point you're buying in, your needs in a home. We may be able to get a seller to pay some or all of your closing costs. So let's discuss that. But step one is to talk with your lender about that number. So we know how much either you are paying or that we're asking the seller to cover. We need to know that information. And then finally, your lender should generate for you a pre-approval letter. Lenders generate pre-qualifications and pre-approvals. With a pre-qualification, they're going off the information you gave them verbally. You may not have given them the documentation yet to prove your exact income, savings, and credit score. With a pre-approval, you've already proved for those things, so the lender can say with great certainty that you should be able to get this loan on closing day. We want a pre-approval letter. We want you to put all the documentation into your lender and have your credit checked because the pre-approval is what the seller wants to see when you make an offer.